Chairman Jerome Powell said last week when he raised rates that his job is to fight inflation and it will likely cause a recession, and he is okay with that. Guys, this is what I mean. Go look at our videos over the last 2 years. We talked about this, over 1,700 videos. Eventually, the party will end. Now, it's amazing how much people are talking about recession. The number one most Googled thing on the internet right now is basically something having to do with recession or job loss. Cycles will happen. You cannot ignore cycles. If you understand cycles, you will do better in investing. Jerome Powell has to fight inflation. When you print trillions of dollars and give it to people, it's going to cause a problem. What was that problem that was caused? Goods were high demand, so prices went up, and people didn't have to work, so labor market got smaller, got tighter, employers had to pay more money in order to get the workers in, and that increased their costs, and it's passed on to the average person. Don't fall for the trap and for the joke that increased wages help the entire economy. It's absolutely necessary. Right now, the worker has the power, which I love. I think it's great that the power has shifted, but there will be a time when we have a recession. And remember, unemployment's currently low, but unemployment is a lagging indicator to the economy. What that means is the economy changes and then unemployment changes. So we're still in the 3.7, 3.8 range, but you have to imagine in the last year and a half, where have interest rates gone? And interest rates have more than doubled in terms of mortgages. But even for lending standards, we went from 0 to 0.25% interest on the Fed funds rate to the goal being around 4.5% next year. In a matter of, at that point, it'll be less than 2 years. What does that mean? It means it costs more money for businesses and people to borrow. And when it costs more money to borrow, they're going to borrow less. Let's first use mortgages because everybody can mortgages. A year and a half ago, my fiance got a mortgage at 2.625%. That same mortgage today is 6%. In fact, somebody told me the other day that the 30-year mortgage got close to 7% just last week. I don't know if that's true. I have not verified that. That is over doubling your rate. What does that mean? The average home right now in this country is about $400,000. So if you put 25% down, that's a $300,000 mortgage. 2.6% is call it $8,000 in interest per year. 6% is $18,000. That's $800 a month. And I talked to a good friend of mine who owns a big mortgage business in Cleveland. He said somebody who's borrowing $300,000 makes around $120 a year before taxes. So let's call it $80 after taxes. You're taking out $10,000 of their $80 as an increased cost. If you don't think that that's going to affect home prices and people's purchasing, you're absolutely nuts. Because now they have to pay $10,000 more. They could have used that $10,000 to buy more stuff, take vacations, buy cars. They don't have that anymore because they're going to pay for a house that they may need to move into. That is a real cost. Look at a business, same thing. If I'm a business borrowing money to expand and I want to borrow $1 million to expand, even $100,000, that's a real cost to me. At $1 million, at $1 million, the difference is, call it 4%, that's $40,000 per year. That is potentially the salary for somebody out there to go have a job in my company that now I have to sit there and pay to the bank as extra money. This absolutely costs the economy. Is that a bad thing? In the long run, it's not. In the last 100 years, the world and this nation, the United States, has seen so much stuff. And guess what? We get better every single time. World wars, assassinations, recessions, depressions, financial crisis, it does not matter. We get better. Does that mean it's always going to happen? I'm not going to go far and say that, but we are still a very productive and innovative society. We will get better. That is what's going to happen. So when it comes to stocks and investing, you're all out there watching going, what's happening? Whenever I hear recession, I hear people say, okay, but what about my stock portfolio? And yes, recessions will get stocks to suddenly fall. Why? Profit margins fall, outlook falls, revenue either falls or slows down significantly. All these things happen and stocks go down. But where do we stand now relative to that? That's the important part. Guys, if you've watched our channel before, you've seen my metrics. And if you haven't, I'm Paul. I'm a value investor who's been teaching investing for 10 years, 3 years of it on YouTube. Just because I have a YouTube video doesn't make me an expert. Just because somebody else has a YouTube video does not make them an expert. But I assure you, I guarantee you that if you watch 4 or 5 of my videos, you'll walk away understanding money and investing a lot better. And even if you don't agree with everything I say, you'll walk away saying, hey, wait a second, this guy probably has a pretty good logical process to investing in money. So I don't agree with Warren Buffett or my good friend Gary on their investing, but I still use what they say as a way of thinking. So you look at history, and I just saw this today. We look at stock market values. There are three major metrics in history that I look at to see where the stock market is relative to value. First one is the price to GDP ratio. Stock market to GDP ratio. This is what Warren Buffett calls the number one indicator at any given time where stock values are. Historically, it's about 80%. Currently, it's at 155%. So about double where it needs to be, okay? That tells me we have a lot longer to go. Another one is the 10-year cyclically adjusted PE ratio. What this does is it takes the last 10 years of earnings in the S&P, brings it all to today using CPI, brings it to today's dollars, and divides the market cap of the S&P by that. Historically, it's around 15 to 16. It's currently at 29 or so, maybe 28. I don't remember the exact number. Actually, I have it right here. It's currently 28.35. Now, both of these metrics here, going back to 1950, where do they lie in terms of their numbers, in terms of how expensive they are? Well, the 10-year, the stock market GDP ratio is in the 95th percentile. That means only 5% of time in history has it been more expensive than today. The 10-year cyclically adjusted PE ratio is at 85%. That means only 15% of the time has stock market been more expensive than it is today. So a couple other metrics that I read about today. The price to sales ratio. Historically, it's in the 89th percentile. It's currently at 2.3. Historically, it's around 1 to 1.2. The price to book ratio right now is at 3.74 in the 86th percentile. Guys, these are 4 or 5 major valuation metrics that have shown a high correlation of future returns, all in the 85 to 95 percentile, 95th percentile in terms of level of expensive. That is scary. Is that a bad thing? Well, depends what you're looking at. If you need to retire in the next 5 or 10 years, you should be worried. And you should talk to somebody about how you can adjust your savings and where you should put it to account for things, for big drops in the market. But if you have a long way to go, 15, 20 plus years, don't worry. Your job is very simple. Dollar cost average. If you've watched our videos, you see this. This is where the stock market's value goes over time. But this is how it gets there. It doesn't go straight up. It goes up and down. But in a long period of time, it goes straight up. It goes up. Your job is to invest all along the way, whether it's overvalued or undervalued. If you buy at all times, the same level at all times, you're going to end up paying this. And doing this alone will beat over 92% of those Harvard, MIT, all those Stanford grads who are running your money in your mutual funds, charging you huge fees and not getting the returns. Over 92% of actively managed mutual funds do not beat the market over a 10-year period. And the ones that do, you probably wouldn't invest in them because they do the best and they're smaller and have less capital. So just buy your low-cost ETF. This is absolutely what you can do. And you might get scared when the market's falling. The Nasdaq's down 30% this year, over 30% this year. The S&P's down another 20-some%. It is scary. And guess what? It will get scarier. But your goal is to look back at history. Go look back at the great financial crisis. Go look back at COVID. Go look back at the dot-com. Go look back at the Reagan assassination. Go look back at every major event in the last 100 years. And you know what? At the absolute lowest point of those stocks, you know what you would say right now? Gee, I wish I invested there. And that's not going to change in the future. You're always going to wish you invested when things were worse. That's what it takes for prices to fall. Things have to be perceived to be bad. When things are perceived to be amazing and awesome, that's when stocks are high. And that's when you should be more cautious. That's what we were doing over the last 2 years. Go look at the comments on our videos when we were bashing Workhorse, Nikola, Tesla, all these stocks that everybody thought were the future. And now a lot of them are down 70, 80, 90%. And the comments were, Paul, you just don't get it. And I used to say, you're right, I don't get it. I don't understand how you can justify these values. And a lot of them have fallen 70, 80, 90%. The ones that haven't fallen that level yet are Amazon and Tesla. And I do believe Tesla will fall 70, 80, 90% from where it is today. It's already down 40% from its all-time high. So it's still fallen. Same with Amazon. But the point is, if you believe in the US economy, then you should dollar cost average. Take the thinking and the emotion out of investing. Your job, go make your money in your job, your side hustle, your business, go maximize that. Go invest in low cost, dollar cost ETFs. Now, if you want to learn more about individual investments, this is a great channel to be in, so make sure you subscribe because I talk about individual stocks on the vast majority of our videos. We do over 20 videos a week, and that's the point for it. So there's a lot that's going to come out. The Fed is going to continue to raise interest rates. That's absolutely going to happen because inflation is still high. Has inflation stabilized? In the US, it absolutely has stabilized. We've seen very little increase in costs in the last 3 months, and that's great, but there's always a cost for everything. And I do believe that Powell is going to use this inflation story as an excuse to do what he always wanted to do, which is raise rates. Back when Trump took office, Powell said he wanted to raise rates. And then Trump came in and bullied him into not raising rates and lowering rates and all that stuff, which I did not agree with. I thought we should have raised rates back then. But it is what it is. Then COVID happened, big mess. But right now, use that opportunity. Recessions are good for everyone. Yes, I know if you lost your job, it sucks. And I'm not trying to diminish that. But you don't lose your job forever, and you'll end up in a stronger economy. Some of the best companies in history were started during recessions, so take it as an opportunity. You need to watch our next video where I talk about how recessions are an opportunity of a lifetime. Thank you very much. Many would say that we are currently in a recession or one is very imminent. Do I know? I have no idea. What I'm here to do is to tell you to remain calm.